Singapore Semicon stocks are down 25 to 30% from their recent highs. But I'm not selling my stakes in AEM, UMS and Micro-Mech. Here's why. 1. Key fundamentals remain intact. 2. The pullback de-risk stretch valuations. And 3. Capping my exposure to the sector protect my overall returns. Let's hand it over to Gemini Notebook for the full breakdown. Or you can read my original post at thefarinvestor.blog.
Welcome to This Explainer. Today we're diving into a situation that honestly tests the nerves of even the most seasoned investors. We are talking about sudden semiconductor market volatility. You know, when the market completely panics, how on earth do you find the conviction to just hold? Let's get into it. To really ground our analysis today, we're going to examine three specific Singaporean tech heavyweights: AEM Holdings, UMS Integration, and Micro-Mechanics. Right now, as an investor, you're pretty much at a crossroads. On one hand, you've got this massive pullback and all the market noise, basically the fear that drives panic selling. But on the other hand, there's thesis-led conviction, which is backed by actual strategic diversification and discipline. The whole point of this explainer is to help move you from that first bucket straight into the second. But first, we absolutely have to address the elephant in the room: minus 30%. After a totally euphoric run, these three local tech leaders took an absolute beating. They fell roughly 25 to 30% right from their mid-year peaks. And look, seeing a third of your portfolio's value in these stocks just get wiped out in a matter of weeks, it's terrifying. It demands our attention for sure. So naturally, this steep decline begs the critical question that is literally weighing on everyone's minds right now. Is the semiconductor supercycle actually over? Are we looking at the end of the rally, or is this just a temporary speed bump? We need to separate the actual signal of what's happening inside these businesses from the deafening noise of the market. We've got to figure out if this is genuinely a time to panic sell or strategically a time to hold. Let's talk about that noise for a second. The headlines rattling investor sentiment right now have been completely relentless. We're seeing breaking reports about China's breakthrough in domestic DUV lithography, which is older but still super essential chip-making tech. And alongside that, you've got this rapid expansion of DRAM, or temporary memory capacity, led by companies like CXMT. Combine those two things, and you've got massive, widespread fears of a future market oversupply. It's triggered this sharp sell-off across global semiconductor leaders. Honestly, it's so easy to read these headlines and just want to run for the hills. But here's where we need to stop and ask: what is actually happening inside these companies? According to our source material from The Fat Investor, the primary reason for staying the course is incredibly straightforward. The operational realities of AME, UMS, and Micro-Mechanics have not deteriorated, not one bit. While the broader markets are out there trading on generic oversupply headlines, if you look closely at their fundamentals, it reveals a completely different story. So let's break them down one by one. First up, AEM Holdings, testing the AI future. To really get AEM, you have to understand their specific niche. Their primary growth engine is driven by system-level testing, or SLT, specifically for high-performance computing and AI logic processors. Think about it. When you have these insanely complex setups, like stacking high-bandwidth memory with AI processors all on a single package, managing the heat and signal flow is a massive engineering challenge. AEM's advanced SLT platforms ensure these integrated packages actually work under intense real-world server stress. It is highly specialized. So CXMT flooding the market with low-margin legacy memory capacity, it simply doesn't displace the need for AEM's advanced testing. When you map out AEM's strategic priorities, you really want to look closely at the memory segment and PC/AI fabless customer pillars. Memory testing isn't some huge vulnerability for them. It's actually an entirely new growth vertical starting from a really low base. Because they're focusing on high-end multi-chip setups, this new runway is just expanding their total addressable market. It's not exposing their core business to those commodity memory oversupply risks everyone is freaking out about. In fact, if we look at AEM's true growth drivers, they are firmly insulated. They are currently fulfilling long-dated, non-cancelable orders for Intel. They're aggressively ramping up volume for a second major AI and HPC anchor customer, and they've got the strategic partnership with the global packaging leader ASE Technology, which basically gives them a direct gateway into advanced packaging environments worldwide. These are the engines driving their top and bottom line expansion. Engines that are completely detached from generic market oversupply fears. Let's move to number 2, UMS Integration, powering fab equipment.
So UMS sits right at the very front end of semiconductor manufacturing. They supply the high-precision chambers and subassemblies that equipment leaders like Applied Materials and Lam Research rely on. Now, if you are worried about industry oversupply, just consider this number: $8.1 billion US. That is the astonishing revenue guidance Lam Research just put out for their upcoming quarter, and that's following a record $6.72 billion quarter. You can clearly see that global demand for advanced wafer fab equipment is absolutely surging, fueled heavily by the high-bandwidth memory buildout. Domestic Chinese tech breakthroughs simply won't soak up this massive global demand overnight, meaning UMS remains perfectly positioned for high-margin order flow.
All right, number 3. Micro-Mechanics, geographic diversification works.
Unlike the first two companies, Micro-Mechanics doesn't rely on just a few massive anchor customers. They manufacture consumable, high-precision tools, things like capillary nozzles that literally wear out during normal production. Because of that, their revenue scales directly with global chip assembly volume. But their true superpower? Geographic diversification. Having a highly decentralized revenue structure spread across global markets gives them incredible operational resilience.
And this brings us to a massive, honestly almost ironic misconception. The myth out there is that China's aggressive domestic chip expansion is a major threat. Well, the reality? China is actually Micro-Mechanics' largest and fastest growing market. For the first 9 months of 2026, China contributed roughly 35% of group revenue and delivered the absolute strongest year-over-year growth at 25.2%. So, dumping this stock out of fear literally means throwing away the very company that's benefiting from that surge.
Section 4. The lesson. Why holding matters now.
Look, discipline in investing comes from structure, not emotion. Our source notes a highly effective risk management strategy here, capping your sector exposure at a maximum of 30%. When the semiconductor rally was at its absolute peak euphoria, this investor intentionally bounded their exposure. And because of this defensive structure, the 30% plunge in those semiconductor stocks only caused their overall portfolio returns to dip slightly, from a peak of 18% down to 16.7%, because they were buoyed by other sectors like banks and U.S. core holdings. That is the true beauty of diversification. You're trading a fraction of maximum upside for total peace of mind.
It's actually super helpful to think of this recent market correction through a driving analogy. Earlier this year, prices were just soaring. Too fast, too furious. It felt like pure momentum trading, basically like driving 120 kilometers per hour on the expressway. Sure, it's thrilling, but it keeps you in a state of high anxiety because you have zero margin for error. This recent plunge, it squeezed out that speculative momentum. It returned us to valuation sanity. We are now cruising safely within the speed limit, totally grounded in actual earnings realities. It's just a much more comfortable place to hold great businesses.
At the end of the day, we have to remember the big picture. The secular AI thesis is still in its incredibly early stages. Yes, losing some short-term paper profits is painful, we've all been there, but it is a necessary trade-off. It is far better to endure this natural short-term volatility than to risk selling out of a massive, multi-year technological shift before it ever fully matures.
Which leaves us with one final thought to mull over. The next time the market flashes red and panic sets in, ask yourself, are you trading on the terrifying noise of generic headlines, or are you holding for the clear, fundamental signal of the businesses you actually own? Stick to your discipline, and the path forward is a whole lot clearer. Thanks for joining me on this explainer, and keep learning.